Good morning and welcome to the Homestead CPA. My name's Dan Snyder. If you're new, welcome. If you're returning to the channel, welcome back. Today we're going to be covering part 9 of a 15-part video series about accounting, tax, and legal issues for homesteaders. Part 9 is discussing the purchase of capital equipment and the tax deduction known as depreciation. At this time of year, at the end of the year, I get frequent calls. As I mentioned in our prior video on transportation expenses, a lot of times it's, hey Dan, should I buy a new truck? If you're a homesteader, it may be, hey Dan, should I buy a new tractor? Should I buy a new chicken coop? Should I buy something? And the reason people ask that is, of course, they're wanting to know, do they need a tax deduction in the current year? Now, the reality is you may or you may not. And that's why you need someone to walk you through what your options are when it comes to capital equipment. What is a capital asset? Capital asset, briefly, is an item that will last for more than 12 months. So if I buy chicken feed, that chicken feed is going to be gone in way less than 12 months. But if I buy a hammer or a rotary saw, something like that, it's going to still be here longer than 12 months. So the rule is that that's what's called a capital item. And so instead of taking an immediate deduction for the item, I would take a deduction over a period of time, what's called the useful life of the asset. And each type of capital asset has a different life. A fence may be a 7-year life. A cow may be a 7-year life. A computer may have a 3-year life. A car or a truck may have a 5-year life. So different assets have different useful lives, and you can talk to your advisor about the types of assets that you have and what their useful life is. So what happens? So when you buy that chicken feed and you pay your fee for your chicken feed, you get a tax deduction right then in that current year. But if you buy a tractor, you don't necessarily get to take the entire cost of the tractor. Typically, you capitalize that and write it off over a period of time, usually 7 years. And there's different types of depreciation, but effectively, the tax deduction for depreciation is supposed to reflect the reduced remaining value of the asset because over time, items tend to wear out. Now, we've recently been through a period where we saw some assets increase in value. We saw old trucks that had been worth next to nothing become worth $10,000, $20,000, $30,000. And yet, immediately before that, you couldn't have given them away. Now, things are starting to come back a little bit back to normal. But the reality is it doesn't reflect, depreciation doesn't reflect actual reality. It reflects the general concept that things get less valuable over time that you use. Why? Because they tend to break. So how is this done? As I mentioned, you have a useful life. And let's just say that we bought a tractor and we paid $28,000 for it. Well, the normal rule, the old rule, would have been we take the useful life of 7 years and depreciate it 1/7 each year, or what's referred to as straight line depreciation. So 28 divided by 7, you take a $4,000 deduction this year and next year and each year thereafter. We are in a new type of depreciation known as accelerated depreciation. And with agricultural equipment, we use what's referred to as 150% declining balance. So in other words, in the first year, instead of taking straight line at 4,000, we would take 150% declining balance, which means we get a $6,000 deduction the first year. And each year thereafter, the depreciation amount goes down because it's based upon the remaining value of the asset after the higher deduction. You may have also heard of what's called Section 179 depreciation, which is a choice. It's a choice that you can make to write off the total amount, the whole entire $28,000 worth of capital asset in the current year, if that's wise for your particular tax circumstances. You may have what's called bonus depreciation. There's been 50% bonus or 100% bonus, and depending upon the year in which you acquire the asset, once again, you may qualify to write off 100% of the asset all in the current year. Is that a good idea? That's why you need to speak to your tax advisor. It may or may not be a good idea. So what happens? Let's say we write off the entire value of the asset, and that actually creates a tax loss for you. Do you lose that? No, you can carry forward to the next year. The problem is that net operating losses that get carried forward to further years can only be used to offset income for income tax purposes. Can't be used to offset income for Social Security, or when you're self-employed, self-employment tax. And for many people, it's hard to say most people, but most of my clients, self-employment tax and Social Security tax can actually be the only tax they may pay. And so if you're not getting a tax deduction for depreciation, you can be leaving money on the table. So this is why I say, speak to your advisor. Did you have a really good year this year? Is your income way up? In which case you may wish to take a deduction for the entire asset. Is next year going to be even better? So maybe we don't want to take depreciation of the entire asset this year. We may want to defer it to a future year. Remember, if your income tax, your average income tax is something in the nature of, say, 20%, and you have your 14% self-employment tax, that means you're saving 34% of the cost of the item if you take the tax deduction at those rates. So it's a valuable deduction that you can take, that you're actually required to take. You don't have a choice, but your choices are, how do you take it and when do you take it? And that's why you need to look at prior year's returns, what your estimate is for the current year, and what you think is going to happen in the future year. Now, this is not cooking the books. This is not doing anything wrong. This is making a choice. You have many choices under the Internal Revenue Code, and depreciation is the one that impacts most people most often. And so if you wish to take a deduction and you limit the deduction, if you've got a number of different assets that were put into service that year, then you may take a write-off of some of the assets, but not all of the assets. What happens if you take a deduction for an asset and now you're dropped down into the 10% income tax bracket? Well, you may not want to take any more accelerated depreciation, any bonus depreciation, because you're not going to get as much tax benefit. Now, it is not my job to make that decision. My job, and the job of your advisor, is to help you understand the consequences of your choices. And if you say, Dan, I want every single dime back that I can possibly get, I need every bit of cash I can get, that's your choice. My job is just to, once again, remind you what the impact of that's going to be. Now, let's talk about different kinds of assets. I mentioned earlier buying a hammer. Now, here's the reality. Most of us will lose a hammer before we ever break it or before it wears out. In fact, I haven't seen a hammer that's worn out. I've seen broken hammers. And so because of that, and because of the relatively low cost of the hammer, typically people will go ahead and not depreciate it, and they will write it off during the year. This is not in the Internal Revenue Code. This is not something that is hard and fast, but it is something that the IRS recognizes. And as long as you treat assets the same each year, they'll respect that. So what I mean by that, let's say that you have a business and your gross revenue is $40,000 a year. You can't choose to write off every asset under $10,000. That's not realistic. But if you say, hey, I'm going to write off every capital asset that's less than $200, you might agree with that, and the IRS would be okay. It needs to be a reasonable dollar number. Now, reasonable for you and I is not the same as reasonable for Exxon. So Exxon will write off any asset less than $10,000 because it's just not relevant to their overall tax position. And keeping track of all of those assets is way more time consuming than it's necessarily worth, either from the position of the IRS or from the taxpayer. So some special rules, but then we also have, especially in our particular homesteading industry, some special assets. And one of those may be pigs or cows or chickens and horses. And you might say, well, what's special about them? So when you buy a cow, as you may know, there's different parts of industries that deal with cows. You may be buying a cow to produce babies because you're running a cow-calf operation. You may be buying a cow because you're going to feed it up during the summer with all the hay you have on your property and then selling it in the winter, a feeder operation. You may be buying a cow to feed it out to then sell it directly to a processor, i.e. you're running your own feedlot, or you may be buying a cow specifically to process yourself for your family. So all these different possibilities. If you buy a cow with the intention of feeding it out and selling it, then that is a cost of goods sold because your intention is to buy and then sell. So if you buy and sell within the same year, you would take a tax deduction for the cost of the cow when you sell it. If you buy it in year one and sell it in year two, you can't take a deduction for the cost until the year you sell it. So you would pay the cash out during year one, but you would not take a tax deduction until year two because it's what's considered to be inventory. Now, let's talk about that good old cow machine that we have. We're buying a heifer and we're going to use her to breed. What is that cow doing? We're buying it to produce other cows. It's like a machine in a factory. And so as a result, it's treated as a capital asset that we can depreciate. So it is necessary to determine what your intention is with respect to that asset, in this case, the cow, and you have to tell your tax advisor what your intentions are, and then he can appropriately deal with the cow. Horses have even more choices because my horse could be a race horse. It could be a stud horse. It could be a mare that I use to breed other horses. It may be a mare that I'm using to implant embryos to grow out embryos from other horses. So there's a lot of different things that can be done with different types of animals. Chickens are the same. Are you buying chickens to lay eggs? In which case, just like the cows producing calves, those chickens, they're like factory equipment. They're producing things for you. But what if you're buying chickens with the intention of feeding them and selling them? Well, now we're back to the whole inventory. So different types of items can be treated in different ways depending upon your intentions. That's why it's really important that you can communicate to your tax advisor what your intentions are with that specific asset. Now, I mentioned this previously in the video on transportation expenses. When you buy a capital asset, you're not allowed to take a tax deduction for it until it is placed in service. And that's a technical tax term. And what that means is that we have a trader business, an enterprise that we are planning to make a profit on, and we have started to use that asset in that trader business. Now, sometimes we buy assets and they're not really intended to be used in a trader business. You might buy a small tractor to use on your property. You're not doing anything. You're not in a trader business. You use it to mow your grass. You use it to keep your property looking pretty. But at some point in time, you change what your activities are, and now you start to use it in the trader business. It's at that point in time when the equipment is placed in service, i.e. you intend to start using it in a business. At that point in time, you can begin to depreciate the item. All of these things are ways that you use to reduce the amount of income that you're earning on your homestead, to reduce not only your income for income tax purposes, but for self-employment tax purposes. So these are things that you want to communicate effectively to your tax advisor. Now, I mentioned earlier talking about what is a capital asset and what's not a capital asset. And in the next video, we're going to be talking about the tax treatment of those items that weren't capital assets, but were in fact supplies or expenses for the operation of the company. So I'd like to thank you for joining us today. And remember, as always, even Jesus paid taxes.